Judas swing, just for the simple sake of looking for a move outside of the Asian range, higher or lower, and then expecting that to be the initial fake out, it's gonna hurt you doing that. Okay, so let's go back and look at the daily range here. Okay, and we have to apply the higher time frame concepts. This is only going to be beneficial to you if we have a higher time frame price level, okay, and maybe an old high back here. Okay, so here's a whole old high in here, key price level. So the chart will look like this. You'll have an open Asian range, and then the Judas swing will occur like this. It'll shoot up into this key higher time frame support or resistance level. Okay, and in the event we're looking at this here, this would represent a resistance level. Okay, I probably should have a different color, so let's do that. It's much better. Okay, so now we have a resistance level on the monthly, weekly, daily, absolutely be looking for, and 4-hour, and maybe even a 1-hour chart. Okay, but you want to have these higher time frame levels on your charts. Okay, and now we're going to introduce the importance of where are we at based on overbought or oversold, because we've touched on this concept with the Trader's Trinity. And over the summer, we did a couple seminars where I discussed some approaches to using the Williams percent R, and I shared that also. I think it's on a video on our live stream channel now. But you would be looking for the pivot levels. If we're above the central pivot, we're in the sell zone. Okay, so technically, in terms of speaking of pivot trading and pivot analysis, that is a overbought region. Okay, so by itself, and again I'm stressing this, by itself just simply means that in the pivot realm of trading, you're overbought. By itself means it means nothing. Okay, but now we're going to add another dimension to it. We've talked about in the Trader's Trinity module, if you have the pivot region overlapping and overbought with an overbought Trader's Trinity, then we have a higher confluence of overbought and oversold. Okay, and if we have a sentiment reading on like the Williams percent R, if it's an overbought reading on the daily chart, or if we have an overbought reading on the last 3 days, like we discussed in a previous video, you can get a pretty good determination that we would expect a high made very shortly after the open, okay, and then a down close. And if you capture it on a time when a higher large range would be expected to be forming, you have a perfect storm brewing. In other words, you have a short-term overbought condition, price trading up to a key higher time frame level, okay, Asian range consolidating, expecting what to unfold. How are you going to anticipate the Judas? The Judas is going to occur as the rally out of the Asian range. Okay. Now what you're going to learn in the reversal profile is sometimes the reversal day won't see the actual high being formed right out of Asia early in London. It won't be there. Sometimes it happens at New York open or London close, or very late after, many times after 1800 hours GMT. So that's we'll cover more of that on the reversal pattern, reversal market profile. But the storm that would indicate that we have a high probability of a large range day with an open near the high and the close being down is greater expected, okay, as a trader. We can anticipate it when we have short-term overbought, key resistance levels, price trading in an Asian range, okay, and then trades up to that level, okay. And now the Judas, the point that you really got to be focusing on when you're looking at the Judas swing is it runs a stop, okay. That's the reason why it's doing it. They're going after one more area of liquidity that we can't see because we don't have the information they have. The central banks, they know where everything's at. They have it. I mean, it's right there in front of them. They can see it. If they know there's, $25 million more, just 17 pips higher, they just reprice it to that, pair up the order, and then it's gone. Okay, and it's that simple. So if we are looking to the left of our chart, there may be a high back here, okay, that would be very clear candidate for a stop raid, especially if we're hovering in overbought and we're Asian range bound, okay, and then we start rallying up. You can see this happening all the time, and many times you're probably seeing it happen in your trade, and you're hoping and praying to God, please don't go up there and knock my stop out. And it does, takes your stop out, and if you were short, and then you see that big drop down later on, but you're too afraid to get back in it, okay? And they know that's what's going to happen. They know you're not going to get back in. They're going to run it up there real quick, start pulling price down the other way. You're going to be stunned. Like a deer in headlights, you're going to be staring at your charts thinking, man, what just happened to me? And the whole time, it's going to be moving in your favor. So a lot of times, being stopped out real quick, that's probably one of the best indications that you had it right, unless it's going to scream against you, obviously. But if the price goes up and stops you out and starts moving in your favor, many times, if you look for a very short-term dealing range level to trade up to, like in a resistance level, or maybe on the other side of the Asian range as resistance, that will give you the opportunity to get in sync with the daily range. So I'm saying all this to build a stage here, because there's a portion in Larry Williams' course where he mentions he makes a little joke about how the open of the day and then price trades around a little bit, and all of a sudden it goes up a little bit and then goes down and closes on its low. Okay, he makes a reference to the real smart people, the real smart money in the marketplace are the guys that sold at the high, okay, and then bought at the low. Okay, now when I saw this in the video, it struck me as someone with OCD. I got an obsessive compulsive disorder where if I get something in my head, I can't get it out until I either accomplish it, okay, or I continue doing it until I eventually get it, okay. And that was a weakness for me when I was trading with really no understanding early on. I got lucky right away when I got into commodity trading after my first initial baptism into loss when I lost on the orange juice trade. But later on I got lucky with wheat, and I bought Chicago Board of Trade wheat, and I made $45,000 in 1 month. And it was purely by luck. I mean, I happened to be in a commercial bull market. It was going vertically straight up. I mean, I could have bought any old day, and you were making money. But that's another rabbit trail for another night. But when he mentioned this in his video course and stating, the real smart money is those that sell at that high and they buy at that low, okay? And he says that, he goes, I don't know, maybe even knowing their zip code may help. Now, he's making a joke out of it, but I'm thinking to myself, okay, well, if he's joking about it and he's teaching all this stuff, that means to me he don't know how to do it. Now I may be completely off base here, and I'm not trying to be disrespectful to him, and I'm not trying to say that I'm better than him, but my focus has always been looking at the gaps and the holes that trader instructors present to us, and I've always allowed my mind to focus on those things and see if I can come up with something that answers that equation. And the Judas swing and SMT divergence was my answer. Okay, so now in my trading, many times I'm getting in short between the high and the upper portion of the Asian range, okay, or the open, where he classifies, and it's very clearly obvious that this is exactly where the smart money accumulates their position. Then during the profit release portion of the day, or the trending portion of the day, okay, or the range expansion portion of the day. There's three terms that, depend upon how I'm feeling, those terms are all going to be talking about basically the body of the daily range. Okay, so if I say either one of those three things, it's really meaning the same thing. I don't mean to confuse you, but I may interchangeably use those. But then what happens is the market will trade down to a key support level. SMT divergence will happen at that low, okay, and you'll see a snap up, and then it'll consolidate and close going into the new trading day. So basically what we're covering is when you're looking at the daily range, all right, your focus, if you're looking for the market to give you a large range day, you have to, number one, have a game plan in mind. We all talk about saying, I want to have a trading plan, okay, and I want to trade my plan and plan my trade. How many times have you heard that, seen it talked about on forums? And you're probably all waiting for me to give you my checklist and the way I do it. Well, you already have it. You really do. You already have it. You just don't have all the little little tweaks here and there that makes it a little bit more accurate. But the main thing that when you go into the trading day, the first thing you need to ask yourself is, where are we going after the open? Okay, after the open, where's this market most likely to go? Because that's exactly what the banks and professional traders are thinking. The open, where we open at, especially you see this phenomenon in the futures market and in stocks, wherever we closed at the day before and where we open up today, that's the public's response. Okay, that's the public view. And you've seen this if you've been watching Larry Williams' stuff. He talks about this phenomenon. For instance, you're a stock trader. What do? They call their broker up, say, hey, how's my stocks doing? Oh, you're up, half a point. Well, that's from yesterday's close. But then at 4 o'clock when the stock's closed, you may be down 1.5 points. Okay, so you measure distribution based on the relationship to where the open to close is. Okay, and the way the public views the market, and you can see here's an idea for you guys that are into programming MT4 indies. Come up with an indicator for your own usage, okay, that plots the cumulative average of the relationship between the open from yesterday's close, and do another indie, okay, on the relationship to where today's open is to today's close, okay, and you'll see the best accumulation distribution indicator you'll ever come up with, because you'll see that the public, they'll be running this thing higher, and it'll look just like the SMT divergence, the way we plot the fiber and the cable together and overlay them. The relationship of watching the open from yesterday's close, that cumulative average, okay, based on what the public views, you'll see this thing, they'll be buying this thing, it's going higher and higher and higher. But if you plot the open to close relationship, you'll see that the professionals are selling into that rally. Okay, and it's right there. I just gave you more $1 million tips than you'll ever need. If you just use that one concept, you don't need to watch anything else. You don't need to see anything else I put on the internet. You have everything you ever would need, because you're going to see every intermediate term swing in the marketplace based on any time frame you look at, because it just happens so frequent. I have arrived at this is exactly how it works. So if this is how it works, it's not going to stop working if I share it. And honestly, this isn't the first time I've talked about these things. I've talked about this stuff in 1998 on America Online, and I had so many more people follow me than you guys. It didn't stop working then, okay? And more people were getting involved with the Forex because, hey, it's easy. You can get in with a small amount of money, so it just makes it much more lucrative. And to me, my mind thinks that it's just going to be much more uniform, and they'll have more victims to slaughter, and you'll have much more symmetry in the marketplace. Right now, we have a whole lot of stuff to work out globally and economically and fundamentally, but that's a short-term thing. And when we get all that stuff worked out, we'll be back to really good trading opportunities where the high is so crystal clear. You guys will be able to see it 2 hours before it forms. So getting back to this without going on a rant, I apologize, but when we have a premise, okay, we reasonably expect the market to be overbought, okay? If the market's overbought and we have an Asian range and it rallies up and we look to the left of our chart and we see a high or a resistance level that would be representing a key resistance level, that's what the Judas is running for. It's rallying up to get that last piece of liquidity before they slam it down. So by doing that, okay, they suck in the guys that are watching the 1 minute and 5 minute charts. And what you'll do is you'll see many times, and you've probably been looking at the charts now since I've released it, looking over the last 2 months, how many opportunities that this presented. You know, the market opens up, goes into a range, you know, it's a false rally up, it makes the high of the day, and then it slams down. Now, the Judas swing, I got this question, I think it was in the thread. How many pips on average is it? Well, there's no set number of pips. Okay, it goes back to the understanding of where are the stops, because they're going to take those guys out before they run the market. Okay, they're going to try to get, because they're greedy, they're going to be just like anybody else. If they can get another 5, 10, 15 million dollars, you know, on the other side of the market, hey, they're going to do that. They want to fill a position for that day, and they're trying to move whatever they're trying to move big block wise. They need that liquidity, so they're going to get those other individuals in the market. So they're going to run it up high. This is your Judas, okay? Because you're all watching 1, 5, and 15-minute charts, and stochastics, even on those time frames, or RSIs or MACDs or whatever, they're going to be giving you all kinds of buy signals down here, because you're going to be viewing that as oversold, and it's going to rally up. And it's going to be like, man, this is easy. Trading's easy. I should have been doing Forex 5 years ago. I'm going to quit my job tomorrow. Look how easy this is. And all of a sudden, they put the brakes on it, and then they slam it down. I mean, you see how many times they do not wait. They do not wait, because they know it's very easy for you to click that button and cancel all open orders and get out of the trade. They don't want that. Okay? They want to have a large enough position, okay, and start running it on the other side of that Asian range to take out the stops again. Why? Because there's going to be some of you that are smart enough to get out. But these suckers down here that have their stops below here, once they run them, you could get out of your trade from when you got long here. But the guys that have sell stops down here, what's going to happen? They're going to get slammed into here. When they drive that price back down here like we did today, excuse me, they're going to get tripped into the market. Okay, so let me make sure I just said that. I don't think I said that correct. No, I didn't say that correct at all. All right, let me rephrase that. When the market goes up, okay, they're engineering a rally. It's a suspect rally. This is the Judas swing. So those that bought in here, okay, their stop loss is going to be below here. All right. So now what will happen is they are long in the market, they trap them, and the bank reverses and reprices aggressively and sends the market lower, stopping out those longs. So now they're lost, okay? But if you look prior to that rally, there may be a dip below the Asian range that sucks in the initial short sellers, okay? So that's what the Judas swing does. It takes out the guys with the original intent to go short. They trip them in short here, below the Asian range, and then they run it higher, stopping those individuals out. Okay, so now the early bears are out of the market. Now the bulls are given the ball for a little while, and they run, you know, a little distance up, okay, and then get them all excited. And then the buy orders are all activated. Now the longs are what they view as in control of the market. And then that's when, during this portion here from the high, from the Asian range high, this portion in here, that's where the last portion of the smart money accumulates their short positions. When there's no more interest, okay, when there's no more interest for them, not us as buyers, okay, this is the false premise that is being taught in technical analysis circles. Markets top, and even you'll hear this in Larry Williams' course too, but it's not a true definition of why it takes place. It doesn't happen like this, guys. Markets do not top because it runs out of buyers. It doesn't. It does not. That's not why it tops out. Okay, it tops out because the banks have fulfilled their order. Okay, we don't need to know how much that is. Okay, we just need to know how price trades to an area of resistance or look for a stop rate. That's all they're looking for. Okay, so if you look to the left of the chart, during the early portions of trading, right after the Asian range forms and going into London, if you see a rally up into this portion of price, and if you look to the left of the chart and there's an old high of some sort here, they're reaching for that area to blow out the stops and then gun it down. Now, this morning, I was unable to get into the rate area, okay, so I had to sell on a stop. So I put a stop loss to get in, not a stop loss, but a stop order to get in short, and I used that as my entry, and then I just simply put 30 pips stop to cover it and protect the position. So what am I saying? I'm basically saying that if we have a stage set technically based on our higher time frame analysis, and we're going to cover that with a real chart, I'm not going to just focus on this little diagram, but if you have the price in an overbought condition based on pivots, Trinity, resistance, oscillators, whatever you want to use, but it's got to be a combination of factors, not just one thing. Don't just simply say, okay, wow, I've seen Michael show this Trader's Trinity thing, and it works great. By itself, it doesn't mean anything. Okay, you have to take it in context to the whole picture. Higher time frame analysis, that's the number one thing. Support and resistance, go back to that. Okay, because we're going to show you exactly what it did today and why it did that. And when it had a combination of all these factors, blending and confluence and convergence, it's magic, man. It's like lightning in a bottle, and you've heard me say it before, it will look like lightning on your chart. And I think everyone will agree today it was a lightning bolt, okay? So, the accumulation that takes place on an overbought situation, okay, simply look at times when, here's a really good example. You're not gonna get a whole lot of trades doing this, okay? But just put a 10 period Williams percent R on your daily chart. All right, and if it goes oversold, look at the next day's trading. If we start ranging at the Asian range and then trades down, you have an 80% likelihood that that's a tradable day to go long, and just look for an exit around New York Open or London close. Okay, there is a intraday day trading method right there, quick, easy, dirty. Okay, but I'm gonna tell you right now, it'll make money. Now, if you blend that with what we already talked about with handling losses and money management, we've already discussed how 25 pips, with 2% risk doubles your money every year. How many times can you see this pay you more than 25 pips in just 1 week? Just one day, okay, like this, you can screw up 15 times, and if you keep your risk controlled, this one day pays for the entire month of mistakes and still come out profitable. Okay, so I know I'm throwing a lot at you guys, and this is what I try to explain to you. In my mind, I have a million things going through my mind at one time, and I'm in a hurry. Really, I want to get this stuff to you, and I'm a little frustrated because I put a lot of work into the videos, and YouTube, they blocked it, and I want it to come out a certain way. So again, I apologize. But anyway, getting back to this. We have the high formed early on because we're overbought. That's the Judas swing. You look for the rally in that stage of trading, and then once it starts to break down, okay, you do not look for 10, 15 pips and get out. And unfortunately, these types of days, because most traders are very unprofitable, they don't have streaks of wins. They have streaks of losses, and then they have a sprinkling of wins, and they're very small wins. As soon as you get that 15 pip win or 20 pip win in profit, okay, on paper profit, unrealized profit, you quickly get out of the trade, and you may get something like this. You'll have something you got short here, and you get out around here, and it feels good. okay, because you got that little bit of movement, and wow, you get on the forum and you can't wait to tell everybody, hey man, because you can't believe you just did it. You made 30 pips, and you're like, man, I just can't believe this. This stuff really works. I got 30 pips, and the whole time it's dropping lower and lower and lower and lower and lower and lower. And what's it doing? It's fulfilling its daily range. All right. So that's the only way you're going to make a ton of money. Okay. And the biggest amounts of money I've made is simply by doing what I did today and utilizing the daily range and capitalizing on the relationship to the open to close, the time of day factor. We already talked about in the London Open session. If you don't get the high made in Asia, it's going to form when? It's going to form in London, okay, Open. If it doesn't form in London Open and it's still trading in a tight range, what do you think is going to happen in New York? It's going to give you the Judas then. They're holding price there. They don't have their orders filled yet. They're going to keep price in that range, okay, and then they're going to engineer that rally during New York. Why? Because they know New York, North American traders are going to come online around 7 o'clock, 8:30 in that region, okay, and they're going to use maybe an economic report, or they're going to use something along those lines. Though maybe they'll use the stock open in New York Stock Exchange. That fever, that excitement, seeing what's the stock market doing, and then all of a sudden, as they engineer that rally up, you just start looking for your SMT divergence. Wait for your correlated pairs to diverge. Look at the stock market indices to diverge. Look at your yields on your interest rates. Look at foreign interest rates. Look at the bonds. Look at the all the things that you're going to learn. And I'm tossing all kinds of stuff here, but you want to be looking for the clues to confirm the premise you had going into the day. All right. So during the open in Asia, okay, if we're overbought, like we're going to illustrate in 20 seconds from now, I promise, we're going to go to a chart. If we're overbought, we're going to be anticipating, okay, this is what you're doing. You're anticipating the false rally out of the Asian range. It's going to consolidate. You want to see that, maybe a little early dip down. Don't chase that, okay? That's the initial sucker play to get the shorts triggered in. Then they run it higher, thinking, okay, all right, look, it was a false breakout down here. Now they're running it higher. It's going to be a buy day. Let me buy it. No, don't do that. Don't do that unless you're scalping, and this is what we're going to talk about when we scalp, because if you think about the London sell signal, there's a lot of profit potential laying on the table if you are very short term and you anticipate that high being formed in London Open between 2 o'clock and 4 o'clock in the a.m. New York time. You can buy the Asian range, okay, and trade long up into the London Open sell template, but you have to be nimble. Okay, so you got to take everything in context, but the real money's made, okay, by what we're sharing here, capturing the high or getting close to the high, selling it, and holding it to when. I don't have the chart window up where I can see what you're saying, but I'm asking you questions to think. I'm not asking you to type it. If you're in what you hopefully consider the high of the day, what targets based on time are you reaching for? Number one, you're reaching for the London close. You're reaching for the ADR to fulfill. You're reaching for the pivot counts, 4 levels, whether it be S1 or mid S1. You got to count all those pivots, not just the major pivots. Okay, so if you get 4 levels in the pivots, if you get the 162 extension, okay, beyond previous day's high or low, and 1,800 hours. That's it. That's it. If you just hold for a confluence of reasons to get out at one of those time frames, okay, you'll get 80 to 90% of the daily range. But you can't do that if you're always rushing to get out of the trade. Or if you got short, say you got lucky today and you went short up in here, all right? And you originally had your stop, like I had, 30 pips, okay, and it starts to trade down, and you get 20 pips in profit, and you immediately bring your stop down. That's what they want you to do, and that's how the optimal trade entry operates. They take that initial run down. They know you're going to be scared, so scared money does what? Runs behind it with a trailing stop loss, 5, 10, 15 points, and then they'll run it back up to get you out of it, and then they'll slam it down. That's why the optimal trade entry works like it does. It capitalizes on the guys that are afraid to lose the unrealized profits when they got it right. They know how you're going to do it, and when you have enough orders being chased with a trailing stop, they'll run it up there. But what are they going to do if they have the high already in place? They're not very often. Let me add that. Not very often are they going to go back above that high. Not very often. But if they do and they come back below it, I'm going back in right there. I'm going right back in at that point because I know what they did was they took out those highs on the stops. They don't want anybody else in there. They're going to muscle them out and then they'll slam it down that way. Okay, so that's the price pattern reflection. You'll see it's kind of like an inverse optimal trade entry. It's kind of cool. I'm kind of holding off on that one because I know it's going to be confusing because if you guys can't see the SMT divergence after we've been talking about that this long, the reflection pattern is going to be very confusing to you. And I don't mean that to be rude, but I just know it's going to be difficult because I tried to share it to my uncle, and it didn't work well. So, looking at the price bar here, okay, if the accumulation of the smart money is here, what do you think they're doing out here? Well, they're short on the day, okay. Well, down here in the latter portion of the day, guys at work are going to be looking at the computer. Hey, man, look at this. The euro is down, 100 points or whatever it is, and the cable's down, 175 points. Well, it's probably going to go down today. So what do they do? They sell it. Okay, well, if they're going to sell it, who's going to buy it from them? The smart money that's gone short, and they're going to distribute their shorts to get out of it. They got to buy, and what are they going to do? They're going to run it up, get it off that low. Now, we didn't do that so much today because we had a really severe down day. They did a drastic repricing, and we were down on the lows at the close, which is very, very strong. But typically, you'll see it come off, and then they'll trade in consolidation, and the price pattern will repeat. Now, if we're still bearish, okay, what would we anticipate on the very next day? Well, this is what happens. You have the Asian range here. Price will wrong color. Price will have an initial range. Okay, it'll trade within a range, and then price will. I wish there was an easier way to draw this. Okay, one more time, give you a Judas. In other words, it'll trade out of the Asian range, go a little bit higher, thinking, okay, well, look, we made a low here. Okay, now it's probably going to trade back up higher. No, what they'll do is they're going to get you thinking that it made the low. It'll trade higher. Okay, suck everybody in because why? What happened in the previous sessions? We had New York down, Asia down, new trading day. You're going into London, all that. Okay, so they're going to reprice and push against those that may have been in the market going short, or those that think it's going to continue going lower, so they drive it higher. This is your Judas swing, and what have they done? They engineered the high of the day again, and then you'll see the same thing unfold. Where when they drive price down below the Asian range, okay, you might get some consolidation and trade back up to it as support. But what are they going to be aiming for in this area? The stops under here. So they'll gun it below there. Maybe retest that low as a high short term in here, and then sell off again. Okay, so that's how you want to be using the Judas. Okay, you anticipate it based on the overall higher time frame analysis. Now again, that may be an oversimplification, but let's look at a actual price chart, and you'll see. Let's look at the cable. Alright guys, can you see everything on the chart? Can you see the price levels on the right hand side? Okay. Let's look at the daily. All right. And this is something that you should have already had in your charts. Right. See this low right here? See this low right here? All right, so you had two price levels being reasonably expecting resistance, okay? Now, we had all kinds of failed attempts to get above those two levels, okay? Failed here, failed here, failed here. We traded down. New trading week, what are they doing? They're sending higher. Why? If you look at the failed attempts here and here, all right, market structure, okay, this is telling you this thing is going lower. It's going lower. We have intermediate term lows, another intermediate term low, okay, it's lower, okay. We are forming another intermediate term high in here, so we will be looking for a sell signal to form. This high down to the low in here, we talked about this on the videos this afternoon. This 50% range from this high down to this low, okay, we're going to zoom in a moment and get a better view of this, but this is fair value in this range. From this dealing range high, this dealing range low, we are trading up into 50%, which is this level right here. Okay, that's fair value. Price, let's go to a 1 hour chart. Price traded in a tight range. Let's put the Asian range in real quick. Okay, you have a tight Asian range. Here's that stab down below the Asian range to get the initial breakout artist to go short. Their stops are going to be placed right above this Asian range high, or this high here, or this high here. Okay, so let's put that level in right there. And I would have been much more inclined to look for a short going into the 156.80 level, institutional level, simply because this high here and maybe anticipating this spike. This is a 1 hour chart. You guys should really know what this pattern is. Okay, inverted hammer, or dragonfly doji, or greystone doji, or key reversal, whatever you want to call it. But that's really bearish. Okay, notice how this high went higher here. These highs here, okay, just these few hours, if you look at the cable versus the fiber, it was unwilling to do that in the fiber. That's the SMT divergence. I know a few of you guys are saying that you didn't see it on there, but it's there. That's all you need. Why? It's diverging at a time when you anticipate going into the day this unfolding. Okay. So now let's go forward a little bit. That's not all we're going to talk about why this set up that way, but we're just going to highlight what happened in price. Price immediately did a drastic repricing, trapping those that broke out long. They immediately aggressively sold off, taking them out. Okay. Took out the stops below the previous day's Asian range and the low made here on Friday's trading. Really hard selling, and then it kept it down here during the latter portion of the day into new trading. and now we're just consolidating again. What else unfolded at that level? Well, okay, you have this high here, down to that low. You have a anticipated high or raid candidate here and here. This price level right here is the 79% retracement level. This price level is the 62% retracement level. What resides between those two levels? Optimal trade entry. And that's what you have here. Okay? The confluence of inverted hammer going into a suspect rally, which is the Judas swing that you'd be anticipating. I got up, I saw that the price had made this here, and I just basically used a stop order to get me in, because if it was going to run a little bit higher, I didn't want to chase into it, because I just didn't see it in time, and I just used the stop. So if it was going to trade down, this is the reason why I used the stop, because I know if it's going to be a false breakout, they're not going to dilly-dally around with it. They're going to send it drastically harder the other way, and I think today is a perfect example of what that would look like. Now, we talked about the targets and how I arrived at that, but we're going to talk about the other factors that went along with. Let's take these other blue lines out, because we've already arrived at their influence on the day. So we have this level here, we want to key in it. Let's look at the Trinity. Let's look at pivots first real quick. Pivots. We'll use GMT pivots to start. And let's go down to the 15-minute chart so we can get a little bit more cleaner chart. Alright, so we have price consolidating in the Asian range, came down, tried to find central pivot, and gunned it up. Okay. Now looking back over the left side of the chart, would you agree or disagree about the respect of price at the GMT pivots? We're going to toggle from the GMT to New York now. This should jump off at you when we toggle from GMT to New York. Which one's being respected? It's obviously the New York pivots. Okay, so the price went down and bounced off the central pivot here, and then gave it one more test here, and then up to what? R1 on the day. All right, R1 just happened to be an overlapping of what would be a possible stop raid on this high here. All right, so now where are we at? We have an overbought region based on pivots alone. Okay, we have a Judas swing going up out of the Asian range. Okay, now let's add to it what we talked about in the Trader's Trinity module. Let's pull up the Trinity on daily using the previous week. Okay, we are trading up into the upper portion of the sell zone. Okay, this is what that red level is here. This blue line here, it may be hard for you to see. Price was actually respecting that also within the Asian range. This is the lower portion of no man's land, or the lower portion of fair value. This is the central level of fair value in here, and in the upper boundary of fair value in here. So we are outside of that in the sell zone. Okay, so using previous week's Trinity, we're in an overbought region there. Pivots, we're in overbought. Let's take this off. And now let's look at the monthly Trinity. Okay, here is the, let me scroll this down a little bit. This yellow line is fair value or equilibrium. Lower portion of fair value. So at this point below, we're in the buy zone by itself, but we also learned in the Traders Trinity module that they act like pivots or broken support and resistance. So it acted as resistance here. So we have a confluence of this price level on the monthly Trinity, R1, okay, the previous week's Traders Trinity was in the sell zone, okay. We have time of day, we have everything lined up for this. Now, watch what happens. If we look at an oscillator, and I'm going to use the one I like, it's the Williams percent R, and we'll just use, we'll use a 10 period. Suddenly overbought means something. Okay, here's your overbought reading right there. Right? Now, let's highlight that. Okay, so you're overbought all in here. Overbought, overbought, overbought. And then price trades to a level where we reasonably expect it to react as resistance. Then you sell off. Now, the oscillator crowd, when we get oversold, they're going to be buying it thinking, okay, it's done. They're going to be buying it as early as here. They're going to be buying it back as early as here. No, you caught the daily trend. You let it run. Okay, do not chase it. Don't tighten up your stop. Let it run. Okay, so if we take all this away, and left with just price, it's hard to see all that. Okay, but I've given you the tools. I've shown you how to use it. Okay, but you're just focusing on one new thing that I just released and expecting it to give you all the answers. And you still got to go back to the original premise, was going to the higher time frames, finding key support and resistance levels. Are we in the sell zone or pivot zone on pivots at a key resistance level? Okay, and just looking at this price level here, we've had clear resistance, right? And it's pretty obvious. See this low over here? There's a level to be watching. Okay, we traded it. We were basically trading at that today. Okay. This high in here, right here. All these areas of reasonable expectations for resistance support. Okay, and you go down to the lower time frames. There's all kinds of levels in there the traders are going to be interested in, right? But you have to use that in conjunction with old highs, and that old high is here, and we could have eventually looked for some run above here as well, but they had enough on the other side of the market. And the failure, let's pull up the fiber just because I didn't talk about the SMT yet. Okay. Okay, this, maybe if I stack it vertically, you'll be able to see it better. Sorry. This is why I use GMT for my SMT, because I'm trying to get it to line up time-wise and show you the divergence, but I'm just going to show it to you this way, and you can find it on your charts on your end. Alright, we have that right there. Okay. I'm going to make higher high there. Okay. And on your end, you'll just have to plot it for your on your charting software package, but on the guys that have GFT, if you use the GFT, you'll see exactly what I saw today. But you still accomplishes it as well here, but it would look like it's not gonna lay like I want it to, because I can't get it to line up time-wise, and so I'm getting frustrated with it. But if you look at your SMT divergence on your charting software, you'll see that this high here, when it ran up on the cable, was unmatched here in the fiber. It's that simple. The order was placed on a stop down here, so when price traded down, it filled it and used the 30 pip stop. And if you look at the daily, and this is really what I want to illustrate and summarize before we close it. Here's the open, okay, the rally up, or Judas, that we saw today, and then down, and then closing at or near the low of the day. All right. Look at this. Now this is what your homework's going to be. Here's another day, the open, Judas down, up, trades off and closes near the high. Okay. Same thing here. Opens, trades up, fakes everybody out, down, closes at or near the low of the day. The open, the Judas up, down, off the lows, closes off the lows of the day. Okay. Here's another opportunity. Open, okay, makes a low, trades up, and trades much more significantly off the highs, but still you can find range to make money in here. Okay. Look at how many times. This is why I like the open, high, low, and close bar versus the candlesticks initially going into the new day, because that's just how my mind operates. Okay, I look at it like this. When I visualize the candle, looking at it, I don't look at it like the candle you see. I see this bar in it, but I'm looking at how certain candlestick patterns form. That it's easier to see looking at candlesticks versus open, high, low, close. But the relationship to open and close, I use the simple open, high, low, close bar like I'm showing you here. Alright, so we have a swing low. Okay, now here's what I want to show you, and I think this is what this hopefully should get you really excited. If you have this daily chart and you have your fractal indicator, alright, I'm going to use red. Okay, we have a fractal low here. This fractal low requires what? For this little indicator that MT4 enables this little arrow to point down or up on, it requires 2 higher lows on the left of it for a swing low and 2 higher lows on the right of it. Alright? Now once that happens, the chart would look like this. Okay? See that? There's your fractal low. Then it's formed. So at the close of this day, going into Asia of the new day, what do you think you should be doing? I'm telling you, light bulbs should be firing right now. Okay, and if you're not smirking, you're going to right now. Here's the completion of when the fractal would form. Your Asian range, Judas down. You buy it. You buy it. Look for SMT divergence. Look for a stop rate. Look for pivot levels. Look for Trinity levels. Look for MACD divergence, oscillator divergence, whatever. Okay, but the smart money is going to accumulate on that down move here. And then what's going to happen is they're going to do what they did on the opposite today. They run the trend for the day. Here's the profit release of the day. SMT divergence in here. ADR fulfilled. 4 pivot counts fulfilled. London close time frame. 1800 GMT time frame be out by then, and they'll sell it off. Okay, and then close off the high. Okay, we still have this fractal, right? So what happens? You have an Asian range. Price trades down. Okay, sucks everybody in. Think, oh, well, it's probably going to go down. You know, as it trades down from Asia's opening range, you got to be looking for something to get long on. Okay, find something down here that's going to provide you an entry point to get long. Runs up. Where's it going to go? Well, it's going to try to gun this high here. Okay, and rally up. Now, falls off the high, closes, consolidates, trades into the next day. Well, we done had what? 3 days. Up, 1, 2, 3 up closes. Well, we got to realistically expect a consolidation or correction. Open. We're overbought short term. It's going to rally up. Judas, sell signal. Slam it down. And then we off the lows. Open. Judas swing up. Get everybody to think it's going to go higher. They sell into that. Slam it down. Boom. Down for the day. Off of the low they close. Well, we had 1, 2 days down. We go into a tight range. You may lose money, or you may miss opportunities in here. That's fine. But now if we have this small little range in here, which really is going to be a Sunday, I know. But I use the Sundays to illustrate how it conveys the concept of range contraction sets up expansion. Okay, so I think Mike Tallandy mentioned that it's always going to look like this. It will always look like this, but I look at the futures chart also, which you'll learn when I talk about the swing trading module, and the ranges that present contraction and expansion on the futures chart will give you a lot of insight in terms of when to anticipate a large range day, and that was one of the factors that was today. I'm not going to cover it now, but you'll see it in the swing trading module. So how can we use this information on swing highs? Well, we have a swing high here. It won't be formed until we have 2 lower highs on the right of it. Okay, so we have 1, 2. So on this day when it closed down, okay, we would be looking for sell signals. All right, opening range, look for a false move above, catch some profits here. Now, if you're looking at the close, it's a little bit higher than the open, but look at the range, the potential for the day. All right, the high on that day was 156.91. The low was 155.81. That's better than 100 pips. Okay, so if you're only trying to get 30, 40, 50 pips, you know, on an intraday trade, you can get that there. But now watch what happens the very next day. The fractal is definitely in formation. We have open, false move above, Judas, down, and down close. You capture that daily range. This day here, the high on this day was 156.54. The low was 154.94. Is there any profit potential in that? I think so. Next day, open, trades up, false, Judas swing, down, catch some profits. The high to low on this day was high was 55.65, low was 54.70. Okay, almost 100 pips there as well. I'm just going to scroll back to any old time. I'm just going to let it fall wherever it falls. Alright, we have a fractal high. Okay, if you're just looking at the daily chart like I've told you from the beginning, guys, from the very beginning, okay, I told you this is where you look. Alright, watch what happens. For this fractal to be valid, we have 2 days lower highs. So what are you going to do the very next day? Asia opens, Asian range, Judas swing up, false move, sucks everybody in, sell it. Boom. Down. Off the low, it closes. On this one day here, we have the high at 155.83, the low at 154.19. Well over 150 pips, one day. Okay, you guys want to capture ridiculous pip hauls? I'm showing you right here. Okay, and this is how easy it can be for you if you know what you're looking for. Okay, and it just repeats itself over and over and over again. You have fractal high here. It requires 2 lower highs on the next side of it. Okay, so we have fractal high 1, 2. So the fractal would appear on your daily chart on this day. So the next day you're doing what? You look for a Judas swing above the opening range. Opening range, shoots up, false breakout, sell it, slam it down. Just this one day here. The high is 162.52. The low is 161.31. Think you can get 50 pips out of that? There, let me give you an instance where you can get. Well, I thought this was going to be a loser, but it's not. Here's the fractal. You have 2 higher lows on the right of it. So the next day, here's the opening range. Wait for the Judas break below. Suck everybody in. False move. SMT divergence. Buy it. Get out later portion of the day. And this range had a low of 162.32 and a high of 163.96. Ridiculous amounts of pips. Ridiculous. Okay. When you get in sync with the trend, okay, you'll have much more daily bars in the direction of the higher time frame momentum. And I'll give you an example of that during August. Okay, we had an up move going on, and I'll zoom out in a second, but for now, you have 1 up day here, 2 days up, 3 days up, 4 days up, 5 days up, 1 down day. Another opportunity to get in here and catch some points, but this is a reversal day. This is a day you'll actually learn the profile on. Okay? But look how many times you can catch that just looking for the false move down when it's bullish. That's the Judas swing. When it's bearish, okay, you're looking for the move above the opening range and then down. Here's the opening, false move up to sell into, down it goes. Opening, false move up, sell it, down it goes. Okay, that's how easy it can be for you. But if you don't have the understanding of what you're doing, okay, just simply because you know there's an Asian range and if it breaks out it's going to do X, Y, Z, is not enough. You have to have everything I've been teaching for over a year now at your disposal, and that way you're not going to be rushed. Okay, now I've been smiling for the last 5 minutes talking about this, okay, and I would be heartbroken to know if this hasn't got you geared up to see how easy it is for you to get your 25 to 50 pips in 1 week. I'm showing you 1 daily range, guys. 1 daily range. You just catch 1 of these for the entire week. Just 1 of these. I think it's Aaron, AK, from the thread. He harps about this a lot, and every time he says it, I'm glad he does it, because you just capture just 1 of these once a week, okay, it's insane amount of money. If you just do 1 of these a month, it's insane amount of money. If you manage your money correctly. This one concept that we've talked about tonight, okay, the power of 3, where we're at from the open to high or open to low, the profit release or the trending portion of the day, and then the low or high to the close, okay? Those 3 times of the day on the daily candle or bar, You have to understand the anatomy that goes along with that characteristic of trading. Smart money accumulates from the open in a short period after that. We know, okay, that if the Asian range is consolidating, it's going to give you the signal in London Open. Okay, if it's going to be a reversal day, it may occur at the New York Open or London Close. Okay, so I just tipped you off to the reversal day profile. You got enough information right there just by me telling you that. Now search out examples of that, and you can see how price trades. And you can actually, I'm going to test you. Build yourself a crude template, like I build my own templates, and the days that I trade are when they're closely resembling the templates that I've released thus far. There's a couple more I got to share with you, but you'll see if you can have this ingrained in your mind that this is when you trade, and you don't trade when it doesn't look as close as these templates can be, you'll be able to avoid a lot of times when the market isn't going to pay you. Okay, there's going to be days where it's seek and destroy and you just can't make money. There's going to be days where it's just too tight of a range and it's not giving you anything. Okay, that's the hardest lesson, and there's just no simple way for me to convey how to do that. That comes with experience, but you can overcome that. That's a very small handicap. Don't let it discourage you. That one handicap can be completely compensated with sound money management, which the module I just gave you with handling losses and inevitable drawdown. That one right there, that module is the absolute key to making millions, and I mean millions of dollars. Because if you can't stay in the game, you'll never be in there long enough to capture these big range days. Okay, and that's where all the money's laid at your feet. It's just like, it's like rain, man, and it's beautiful. It's a great feeling when you get it. So I think I mentioned that we're going to talk about real quick, and I'm going to close it here, why it was going up like this. Let's zoom out. And this was that swing here in August where it had several days up, and it's because we had a short-term bounce in the marketplace. And if you look at how many times during this down surge, look at the relationship from open to the high made very closely after the Asian range was broken, giving you a Judas swing. Real quick, we'll just count them. Here's 1, 2, the fractal would have formed here, so we're going to go, that's an up day. Here's 1 down day, 2 down days, up day, 3 down day, 4 down day, 5, 6, 7, huge one right there, 8, 9, 10, 11, 12, 2 of them where you wouldn't have caught, maybe 2 losses here if you were really being aggressive, 13, 14, 15, 16 days of just looking for false breakouts and reasons to sell against a run above the Asian highs, or using the London Open sell template. Okay, because you got all the higher time frame analysis in your favor. The money's laying right there for you guys. All you gotta do is dip your net in the water and you just get it. Okay, you have to have the proper understanding of what you're doing and not reacting. Okay, don't just look at my videos and say, wow, you know, this thing worked 15 times on its examples, you know, it's probably going to work today too. If there's no real reason to anticipate that premise in the market for that day, the tool ain't going to work, man. You don't paint a house with a hammer. So understand that I've given you concepts, okay, and I'm drawing them all closer together now into a synergistic approach to implementing them in a profitable way. So I hope that you gleaned some really good insight out of this. I think I've covered the trade today, but real quick, let me cover one more concept about it. It's using hourly. Let's throw okay, so we are below the oversold region. Okay, if we continue to break down, we learned that we would use the low to high 161 and 200 extension. Here's 200, and here is the 161 extension. Now, it's interesting that 152.80 institutional level converges with the 162 extension. Notice also that if we do have a further slide, that it almost gives you the fulfillment of a bear flag if this is in case a bear flag. It's too early to tell. Note also that 162 would essentially blow out this low here, and that would be my expectations for price to be maybe even reaching down below here to get the stops. And I know those fractals are taking up a lot of space, and I apologize. Let me get that off. Okay, so it may be reaching for this low. I do not, and I wouldn't anticipate price snapping up from here and going northbound until at least, if it does at all, it would most likely take this low out before it did. But I don't see that happening. But it could. I mean, it could reasonably bounce up to this level in here, and retrace, and then fall off further. But I definitely would not be looking to be buying this market. So if you're asking what my insight would be in here, I'm done. I'm absolutely done. I don't care what it does from here. But today was just so loaded up for a nice slide that it was just too easy not to get in there and take it today. And I just wish I would have had a couple more minutes awake to realize what it was unfolding, and I could have done a lot better job of illustrating it. But if you look down here, like I said, I shared this earlier. This was the trade, it was the stop, and the take profit was triggered, and just on an 8 lot standard represented a $14,640 win. But this, for disclosure's sake, this was a demo account mirroring an actual trade, because I'm not going to put my trade up. No, I'm not going to put my account on here for you to see, because I don't trust my ability to hide the account number or be able to move these little things around to keep it off. So you're just going to have to take that for what it's worth. And again, I'm not a trade advisor, so we're all going to be talking in demo terms. So for my safety and your safety, past performance is not indicative of future results. You will lose money, so that's that. So I'm going to take a look at what you're saying, if you're saying anything. And all right, let me close the recording out, guys.